Good morning, and welcome to Global Markets Daily Brief. I'm Jonathan Simkowitz, and today is Saturday, February the 21st, 2026. And the only question that matters this weekend is whether the Supreme Court actually put a leash on the tariff machine or just forced it to change its color. Here's what happened. Yesterday, the Supreme Court ruled 6-3 that President Trump's sweeping tariffs imposed under the International Emergency Economic Powers Act, known as IEPA, were illegal, striking down the legal basis for the vast majority of import duties that have defined trade policy for the past year. Markets briefly rallied on the news because, on paper, this looked like the biggest rollback of protectionism in modern American history. But within hours, literally hours, the president signed a new executive order imposing a 10% global tariff under a completely different law, Section 122 of the Trade Act of 1974. And then this morning, he raised it to 15%, the maximum allowed under that statute, posting on Truth Social that he was hiking it to the fully allowed and legally tested 15% level, effective immediately. So the market's first reaction was a head fake, a brief euphoria that the tariff era was over, followed by the cold realization that the administration has no intention of backing down and is willing to use every available legal pathway to maintain import duties. The rally on Friday evaporated as traders digested the replacement tariffs. And by this morning, the picture is clear. The trade war has not ended. It has simply changed legal jurisdiction. Here's what most people are missing. And this is critical. The Section 122 tariffs come with a built-in expiration date of 150 days. That puts us right around mid-September 2026, just as the midterm election cycle reaches its peak. That means every single corporate earnings model, every supply chain forecast, and every inflation projection now has a new variable. Do these tariffs expire? Does Congress extend them? Or does the administration escalate into Section 301 investigations that could result in permanent tariffs of 25% or higher on specific countries? The administration has already signaled that Third Path U.S. Trade Representative Jamieson Greer announced that Section 301 investigations would be open against most major trading partners on an accelerated timeline. That process was the basis for the original China tariffs during the first Trump term, and it is slower, but legally far more durable than anything the Supreme Court just struck down. Now, what's priced in right now is essentially a tariff floor. The market believes that at minimum, a 15% global duty is the new baseline. And that is actually a meaningful reduction for some countries. China's effective rate, for example, drops from around 55% under the old IEPA regime to roughly 35% because the new tariff layers on top of existing Section 232 and Section 301 duties rather than replacing them. But what is not priced in is the uncertainty itself. The 150-day clock creates a fiscal cliff in September that will force businesses into a wave of inventory hoarding over the next few months. Companies will front-load holiday season imports before the tariffs either expire or potentially get worse. That surge in demand could temporarily inflate shipping volumes, port congestion, and short-term economic activity, only to be followed by a sharp drop-off in Q4. There's also the refund question that nobody's talking about. The government collected an estimated $160 to $175 billion in IEPA tariff revenue that the Supreme Court has now declared was collected under an illegal authority. The court did not order refunds, leaving that to the lower courts, and Justice Kavanaugh warned in his dissent that the refund process is likely to be, in his words, a mess. If those refunds are eventually ordered, even partially, it represents a massive fiscal event, money flowing from the Treasury back to importers, which could act as a one-time stimulus for corporate balance sheets but simultaneously blow a hole in federal revenue projections. The budget math on this is genuinely uncharted. The trade-off is this: on the positive side, a uniform 15% tariff is simpler, more predictable, and lower than what many countries were facing under the IEPA regime, which means corporate planning gets marginally easier in the near term. On the negative side, the administration has made clear this is a floor, not a ceiling. And the Section 301 investigation signaled that country-specific tariffs could snap back to much higher levels within months. What to watch first? any congressional action on extending the Section 122 tariffs beyond the 150-day window. Because if Republicans signal willingness to codify them, the expiration risk goes away and the tariff floor becomes permanent. Second, the pace and scope of the Section 301 investigations, because those will determine which countries and sectors face escalation from 15% to potentially 25% or higher. My base case is that the 15% global tariff holds through the summer. The Section 301 investigations are used selectively as leverage in bilateral negotiations, and the 150-day clock becomes a slow-motion negotiation tool rather than a hard expiration. Think of it less as a cliff and more as a deadline that keeps getting extended. The bull case is that the Supreme Court ruling fundamentally constrains the administration's tariff ambitions. The 15% rate is the ceiling rather than the floor. Trading partners strike quick deals, and the combination of lower tariffs plus potential refunds acts as a meaningful tailwind for corporate earnings and consumer prices in the back half of the year. The bear case is that the administration views the Supreme Court ruling as a personal affront, which the president's rhetoric strongly suggests they accelerate every alternative tariff pathway simultaneously. Congress codifies and expands the duties, and the refund process gets bogged down in years of litigation, leaving importers with no relief and consumers with persistently higher prices. In that scenario, the Fed stays on hold indefinitely, and the soft landing narrative breaks down. This is market commentary, not financial advice. Always do your own research and consult a qualified professional before making investment decisions. If this breakdown helps you understand what the TARIFFS substantially means for your portfolio, please subscribe to Global Markets Daily Brief or have you always leave all with you, and I'll see you way that you and Monday more.